This is MacroVoices with hedge fund manager Erik Townsend, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Erik Townsend and Patrick Ceresna.
MacroVoices episode 262 was recorded on March 11th, 2021. I'm Erik Townsend. This episode is brought to you by Abaxx Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. And by Diamond Standard, the world's first regulator-approved diamond commodity. A $1 trillion natural resource is finally liquid. Visit diamondstandard.co. Quadriga Asset Management Portfolio Manager Diego Parrilla returns as this week's feature interview guest. With apologies in advance to those of you who are waiting for a deflationist, we really do have some of those guys in the pipeline, folks, but Diego is in the inflation camp. We'll discuss why and talk about what the inflation trend means for bond yields, equity markets, and commodities. We'll also discuss gold, the VIX, and much more. Then be sure to stay tuned for our Postgame segment when Gold Royalty Corporation CEO Amir Adnani joins us to discuss the royalty and streaming business models for precious metals and where precious metals streaming shares fit into a portfolio allocation strategy.
And I'm Patrick Ceresna. Erik, let's jump to the S&P 500. It continues to be a tale of two markets. The NASDAQ is a huge laggard, but the Russell, small caps, the S&P 500, everything seems to be back, particularly those kind of cyclical areas and financials have continued to plug away. And the S&P is trying to plug to a new high. What's your take on all of this?
Well, my plan for this week, Patrick, was to use my same line from last week and say it's been 3 whole weeks since no new all-time high. Oh, my gosh. Trying to make a joke about it. Guess what? It looks to me like maybe we are going to hit a new all-time high today if we didn't already. I can barely see on the screen whether it's a high or not. This is obviously not what a blow-off top looks like. A lot of people for the last couple of weeks have been panicking. Finally, we're seeing at least some consolidation in the market instead of straight up. But, I think the message here is yields matter. As soon as we saw a reversal in the 10-year yield, all of a sudden they're buying the dip. So I think the real question to focus on is how far can that 10-year yield back up? Is it going to resume backing up, or is it over and done with? We had David Tepper, who, of course, is very well known as the guy who was first to really be outspoken in saying QE is good for the stock market back in 2009, saying, okay, that's it. We're done with the bond yields little excursion. It's all up from here for stocks and all down for bond yields. Is this thing really over or not? It seems to me like the real question is bond yields, and what the stock market's going to do next is probably dependent on that. And what bond yields are going to do is, of course, dependent on the Fed and how long they're going to take before they really start to step in and not allow yields to go any higher if they should continue moving higher. So I think this is really all about bond yields.
All right, well, let's move on to the dollar index. We had the ECB and Lagarde talking, and the euro a little bit up, so the U.S. dollar's giving back some of those gains that it had from the breakout temporarily above 92. You think this is just a pullback, or you think that's it for the dollar?
Well, I was assaulted on Twitter this week by people saying, see, we got above 92. It's above 92. You got it all wrong. And I said, guys, wait a minute. We had one daily close above 92, which promptly retraced and has been going straight down ever since. It's early to call this yet. What we know is 92 is the critical resistance level. We had a very good test of it this past week. It looked like maybe there was going to be a breakout. So far, it's retraced back down, and it's a false breakout. But it ain't over till it's over, and so maybe we're going to see another attempt. We need to see it get above 92 and stay above 92 in order for this to be a meaningful breakout and a reversal of trend direction. Right now, all I see in the chart is, it's starting to look real interesting. Let's keep a close eye on it.
All right, Erik, let's move on to crude oil. I want to know how the inventories came in and what you thought of everything on OPEC. But right now, oil is edging right back toward its highs. I mean, is this done? Are we going to see a 70 handle on oil here in the next week or two?
Well, Patrick, Sunday's opening price spike was all about the Saudi Arabia attacks over the weekend. And of course, the market has some memory that the last time prices spiked over a weekend because of an attack in Saudi Arabia, it actually turned out to be a sell. So the market has since corrected, but now it does appear, as you said, to be moving higher. We're back above all the short-term moving averages into uptrend territory. The Texas freeze out is still skewing all the inventory numbers, and therefore we have another week of people who don't understand the market completely misinterpreting the inventory. Crude oil building 13.8 million barrels sounds like a massive build until you consider that the drawdown in finished products was 17.4 million barrels. So 13.8 build in crude, 11.9 draw in gasoline, and 5.5 draw in distillates. That's a total of 17.4 drawdowns, or a net 3.6 million barrel drawdown, not build, in total petroleum products inventory this week. Everybody's focused on the headline build in crude oil, and they don't understand what's happening. You've got to look at the big picture. U.S. production up a whopping 900,000 barrels, almost a million barrels. Again, don't take that out of context. What's really going on is it was 11 million barrels before the Texas freeze out. We went from way down to almost all the way back. So instead of 11, we're back up to 10.9, which is 900,000 higher than we were last week at a very artificially depressed print last week. It's not clear whether this market rally is going to have a more meaningful correction here or not. Frankly, we could see a $10 or $15 move down, and it would just be a healthy correction in a bull market. So the way to interpret this market, Patrick, is I think that the fundamentals really are there for much higher prices. In fact, I'm going to go out on a limb here and make the prediction that I think by the end of 2024, we're going to see a new all-time high above $147 a barrel. But the question is really not whether that's going to happen, but what's the path to get from here to there going to look like? And certainly we're overdue for at least a technical correction.
All right, let's move on to gold, because gold's like 3 days off of its lows, but it's not really about that's just bouncing off the lows, but it did turn about the same time as Treasury bond yields turned. Do you think that there's anything to this? Like, do you think a short-term low could be in, or is there this trend still going to remain in play?
I think you touched already in the context of your question, Patrick, on the real answer, which is this is about real yields, and of course, nominal yields drive real yields. So if the Treasury yields continue to decline, I think that probably was the bottom. And frankly, there's a good technical argument to be made that 1675 was a key support level, and it made sense for that to be the bottom. Remember just last week, when we had Ola Hansen on the program, he said that was a very key. Actually, I think the number he gave us was 1680. We ended up getting down to 1675. He said that was the key technical level that had to hold, and if it didn't, we're in real trouble. The question is, are Treasury yields really done, as David Tepper told us that they were this week, or are they not done? And I think that's going to decide what happens next. I'm buying this bottom. I don't know if it's the bottom or just a intermediate bottom along the way, but it's time to be buying here. So I'm buying both mining shares and futures. Also participated in an IPO for a gold royalty company. And we're going to get Amir Adnani, the CEO of Gold Royalty Corporation, to join us in the postgame segment to talk about this royalty and streaming business model, because I think it has a lot of appeal, and certainly the timing is right to buy it down here. So that's coming up in the postgame segment.
Well, Erik, that's a perfect segue into that 10-year Treasury yield, because we had the 30-year kind of already peaked out around 235 for the last couple of weeks, and the 10-year just above 160, and it's all coming a little bit off their highs. I mean, nothing to write home about yet, but the yields certainly are backing off a little bit. What's your take on this?
Well, Patrick, as you say, the gold question and the Treasury yield question are really the same question. If this backing up of 10-year yields is over, then I think the gold correction is over, and I'm not convinced that either one is over. And I think it remains to be seen. I've reached a point where I don't think I'm smart enough to really know the answer as to what's about to happen in long-dated Treasury yields. I'm trying to ask all of our smartest guests that exact question, and I'll certainly ask Diego that question in today's interview.
This week's featured interview guest is Quadriga Asset Management Portfolio Manager Diego Parrilla. Now, Erik, why did we invite Diego back this week?
Well, Patrick, Diego is a super smart macro guy. He's an energy guy and he's a precious metals guy. And those are all very important topics in this environment. And it's frankly been too long since we've had him on the show. So I'm looking forward to getting him back on.
Erik's interview with Diego is coming up as Macro Voices continues right after this message from our sponsor.
This episode of MacroVoices was made possible by Abex Technologies, which also sponsors my new Smarter Markets podcast, which airs every Saturday morning and explores how the markets themselves could be redesigned to better serve market participants and society as a whole. My interview with Bill Pezos, head of Air Carbon Exchange, is available now at smartermarketspod.com. And my guest on Smarter Markets this coming Saturday will be a return of billionaire financier Robert Friedland for the first of a two-part interview series titled What It Will Really Take to Green the Global Economy. This is an absolutely fantastic interview, folks, and I really encourage you to listen to this interview and the one next week, because those are kind of be prerequisites to our Macro Voices podcast on the 25th, when we'll have Robert returning here on Macro Voices to talk about investing in how we green the global economy. So you've got 3 exciting interviews with Robert Friedland coming up in coming weeks. But you won't find Smarter Markets on your Macro Voices feed. You have to separately subscribe to Smarter Markets in your podcast app to receive this free new podcast.
And now, with this week's special guest, here's hedge fund manager Erik Townsend.
Joining me now is Diego Parrilla, portfolio manager for Quadriga Asset Management and best-selling author of the books Anti-Bubbles and The Energy World is Flat. Diego, it's great to have you back on the program. A man who follows energy markets and whether or not they're flat or not, I got to believe is thinking about inflation. But I'd rather have you tell me you're a deflationist, because we can't seem to find any smart deflationists left. Let's start with inflation versus deflation. How do you see the whole story?
Well, thank you for having me back. Look, I think the end game is inflation for sure. But what is very important to understand is there are very, very strong forces in both directions. Clearly, on the deflationary side, we're dealing with potentially unemployment. Obviously, the economy is recovering, but still lagging substantially. We have technological benefits and considerations that are deflationary. We have demographics. We have overcapacity. We have malinvestment. We have potentially bubbles, which are hugely deflationary. So all these things point one way. However, there's just one thing or one major force on the other side, which is money printing in the trillions that is basically more than offsetting them all and beyond. So it's almost as if the more deflation in the system, the bigger of an excuse and the more room central banks have to print or try to print their way out. Needless to say, the trillions of money printing are not solving problems. They are really doing a number of things. They're, in first instance, just delaying the problems. You're kind of kicking the can through debt. Second, and very importantly, we're transferring those problems through currency and trade wars, which is hugely relevant. And we're seeing a lot of action in that front with the dollar and everybody else trying to print their way out. Thirdly, we're transferring the problem, or transforming rather the problems, which is, as you mentioned, inflation as well as inequality. Let's not forget. And eventually, this is all leading to bigger issues. So I think the inflation-deflation debate, based on the fact that there are lots of issues and deflationary forces, but ultimately this major one, and things, I believe, eventually getting worse, we know that mommy and daddy pretty much have no choice but have to come back and do more of the same. So it's just a matter of time before this fragility gets tested, and I think more to come. The scenario whereby we grow our way out and you normalize things, I think it's wishful thinking. But yeah, I hope I'm wrong. I think the decades of artificial low interest rates and these artificially high valuations and these bubbles we've created everywhere are a ticking bomb, and that's why I think it's a matter of time that inflation picks up. And I think in that sense we're looking at this first phase of contained, optically stable markets, but I think the things could accelerate, and that's when things start to get a bit more tricky. And to some extent is what we're starting to see in the rates markets as a message to the Fed.
Let's go a little deeper on the rates market. Ever since Joe Biden took office and announced an intention to engage in fairly aggressive deficit spending, we've seen a backing up in long-dated Treasury yields. And on the Monday that you and I are speaking, a few days before this interview will air, the big news that hit the tape was fund manager David Tepper kind of declaring, okay, I think it's gone as far as it can go, the backing up of yields in terms of a panic reaction or a knee-jerk reaction to the Biden administration is over, and therefore he's declaring it should be, all uphill from here in terms of equity prices. How do you see this rates market, and particularly the long end of it, 10-year and 30-year, and at what point do you think the Fed is likely to start to intervene, whether it be with Operation Twist or something else?
Well, I think it's helpful to put things in perspective. We are heading into 2007, 2008. We have a yield curve with nominal yields and rates around 5%. And that was an incredibly flat curve. Your front end, your Fed funds, your 10-year, your 30-year, they were all sort of hovering around that level. Post 2008, you have this major move down in the front end of the curve with QE, but the back end of the curve initially stayed reasonably high. It was considered to be more of a short-term temporary thing, and short-term rates try to do the job. And then as these temporary things become permanent, the pressure on long-term yields increases. And in Europe, we introduce negative interest rates. You go all the way into negative yields, all the way out, and basically long-term yields come off, arguably for a sustained period of time. And then we go into 2018, right? That situation when famous Jerome Powell's autopilot, we got to the point where the normalization took us to about 3%. Once again, you had a very flat curve. The front, the belly, the back end, it was all more flat, the market pricing hikes, and obviously following almost a decade of printing and debt, of course, the system starts to implode. And so result of that, and since then, what obviously has been the biggest shock in memory, which has led to the biggest response across monetary and fiscal as well. We go to this situation where everything goes pretty much to zero, right? The front end, but also the long-term yields collapse to historical lows. What we're seeing now, I think it's a bit of a repeat where we see this move up, as you point out. What's the limit? The 30-year at 225 and the 10-year, so to speak, at 160. are still somewhat a long way. I mean, the 10 years pretty much half of where we were before in 2018, whereas the 30 years is 2/3 of the way. But I think given the massive increase in debt, we're once again in a situation where the system can't really cope. I mean, as I always say, all the listeners on this call can afford a $1 trillion mortgage at zero. The problem is when rates go up, even marginally, right? So I think in that sense, the one thing that is hugely important is not just about yields, is to understand that everything else, this artificial low level of interest rates, which we've had for a long time, have created artificially high valuations in multiple other assets. And everybody, I guess, understands the relationship between fixed income and interest rates through duration, right? So you look at 10-year bonds or 30-year bonds, and you see the impact that interest rates have. What is very obvious, in my opinion, and less well understood, is the idea of equity duration. And this is effectively the sensitivity also to long-term interest rates. And, I think here the math is less obvious. There's tons of academic work that looks into into equity yields, and as a result, by comparing that to the equity risk premia, and you have this situation where people are comparing apples and pears, right? You compare whatever the S&P or the Nasdaq with 10-year yields, and people would argue Treasury yields, and people would argue that equities are cheap or whatever. I mean, it's pretty obvious. I don't think anybody here will debate that equities are expensive in absolute terms. That's, by any single conventional measure, they're incredibly expensive, and we're coming up with new measures. But this fallacy, in our opinion, that equities are cheap on a relative basis, it's such because according to our numbers, the duration of the S&P is roughly about 28 years. So when you look at and you compare whether equities are cheap or not relative to fixed income, you need to compare to that back end. And certainly, and we published some analysis on this called No Premium in Equity Risk Premia. The situation is way worse for growth stocks and things like the Nasdaq, where the duration is, in our view, closer to 40 or 50 years. Just look at what's happened to long-dated bonds, and that's really just purely from a duration rates perspective, what should be happening, and in fact, what's been the case with the Nasdaq. But certainly, we think that there are limits. Pinpointing exactly to what's that number, I think we could do some back of the envelope exercises and say, well, ceteris paribus, all else being equal, what sort of level were we in 2007 when we popped, basis 5% interest rates and a level of debt of X. That translates roughly to where we were perhaps in 2018 with rates at 3. And I think it's fair to say that where we're now is not far from those levels, if not surpassed. And if you combine that to basically the linkage between all the other bubbles we've created in the process and the sensitivity of the system to long-term rates, I think it's a very fragile situation, which basically it's a matter of time. Either this move up if this move up in long-term yields is unchecked, and the Federal Reserve is, as always, positioning these things as temporary. If this thing continues this way, I think you will see a bigger shock on the equities, which will almost self-correct through the fixed income. And I think it could be either something you do preemptively or just forced to do it. And I wouldn't be surprised if you have a combination of both. So, as the equity markets start to be under more pressure, the Fed gets active. Even if they don't make the formal full announcement, they're already monitoring and watching. So they're putting a straight face now, claiming this is all healthy. This is potentially very dangerous, very fragile. And I think there's a number of mechanisms by which this accelerates. Perhaps the most obvious one is volatility.
This fascinates me, this idea of equities being valued based on bond rates, and you can make this logical argument that says, given where Treasury rates are, equities are actually undervalued. And people act like that's just perfectly logical. It seems to me, Diego, as soon as you get to negative Treasury yields, which we've already seen in Europe, doesn't that mean that by that measure, equities have a value of infinity?
Well, absolutely.
So, at what point do you acknowledge that this is kind of crazy to measure it this way?
No, it is absolutely. I think there are so many crazy things out there, and negative nominal yields and negative real yields, and it's sort of how things are playing out. What you're describing is a change in rules of the game, right? And I think what's very important that everybody understands is this is 100% artificial. Okay, it's 100% artificial. The whole level of front-end interest rates is artificial. Then that starts to put pressure on long-term yields through carry and desperate search for yield and QE and manipulation of long-term yields. If those things decided to have a life of their own and challenge valuations, then no worries. Let's do Operation Twist and QE and manipulate long-term yields as well. And that crashes volatility. And you just continue this fully artificial setup, which all it's doing is creating this ginormous complacency and bubbles. And yeah, I mean, you could think about once upon a time, you would like to short the Widowmaker, the JGB market. And you would argue at one point, if you're playing by conventional rules of the game, yeah, if I'm shorting this thing at 99.99, then what's my downside, right? It's just 0.01. And suddenly you go into negative rates and negative yields, and it's kind of game over. The bond market doesn't have a ceiling anymore, and it just becomes a number. And I think that translates directly into equities, and this whole fallacy eventually creates these bubbles that are, let's not fool ourselves, they're by now too big to fail. And this is where we are. We are in a situation where we just build this, massive house of cards with the wealth effect kicking the machine, and then we all have this perception of wealth. You look at your bank account or your share price or your Tesla or whatever you want, or Bitcoin, and you see all those valuations without recognizing that perhaps it's all artificial. And what we've seen over and over in this crisis is when the emperor has no clothes and these things get exposed, it's systemic. And that sort of forces mommy and daddy to come back and just do it all over again. And so we're in this, from a game theory perspective, back to your first question on inflation, it's pretty obvious where we're going to end up. But the danger here is so obvious and it looks so clear that mommy and daddy have a vested interest in not letting this thing collapse, that what shall we do? Shall we just lever the hell out of this and just play the game and go all in with all? And then the problem is you're going to have these major, vol moves and shakeouts as we have in COVID, which could be more or less expected. But I think volatility is on the rise, and this is one of the things that will put things in check. And so it's becoming increasingly more polarized. I mean, even the debate between inflation and deflation, or Bitcoin 0 or a million or whatever, this polarization of the world eventually it just translates into vol, right? So one day I'm correct, the day after you're correct, and this thing just swings from one extreme to the other. And then all we know is that volatility is bad news for risk, both realized and implied volatility. This eventually creates, it forces you to cut the size of the positions, and it creates a vicious cycle as, volatility increases, and perhaps some of those positions get reduced, and then there's deleveraging, and then correlations increase because everybody has the same trade, and liquidity thins up. And before you know it, you get into a dynamic where I use the analogy of fluid mechanics, where the world, nature, has two main regimes, the laminar regime and the turbulent regime. And in a laminar regime world, it's all predictable, it's all linear, it all makes sense. But once you go chaotic into turbulent, then things get out of control. And that's, to me, one of the dangers. You're flirting here with the VIX. It's very contained. It's a bit, which I think if it breaks 40, everything's go really out of control. And this is why we have this situation where I think the central banks need to be ready to act, and why I read between the lines. I agree with you that it's just a matter of time that mommy and daddy come in and intervene in the long end, because it's all related. I think this path of artificial low rates, artificial low credit spreads, artificial low volatility, complacency, bubbles, becomes so one way that eventually even the Fed tries to put some steam out of it, and the wishful thinking is they can do that without this thing imploding in their faces, and they know that in order to do that, they need to control to some extent and intervene, and that this is the dependency we're in, and why I think this is such a tricky market to play, and perhaps a lot more fragile than it might look.
Well, it sounds like we agree that if you're dealing with artificial economics and everything is being created by the central bank, then volatility really is your best indicator as to what's going to happen next. Now, the VIX is clearly on the rise, but, it's not back to 2008 levels or anything. Should we interpret this as the market is topping and perhaps it's time to think about a cyclical bear market starting? Or do you think it's just a question of time until the Fed intervenes yet again in a way that takes us even higher in terms of equity valuations?
Well, I think volatility, we've clearly got into a new regime, I think, a regime of more higher sustained vol levels. Just about a year ago, heading into the February-March debacle, the VIX was in the low teens, right? We had this extreme level of complacency where, you were able to buy insurance the cheapest when you needed it the most, right? And after a very prolonged period of time, plus obviously what happened, we had a spike that was only comparable to 2008, right, with the VIX 80 plus. So since then, obviously there's been a phenomenal move up in equities. We've made way more than, reached the previous highs and by a long way. And however, the VIX has been somewhat stubbornly holding above, the low 20s. And I would highlight a few things. The first thing is we're in this higher level of vol. So, 20 low in the mid 20s. The second thing that is very remarkable is the shape of the curve. You have a very, very steep contango, currently almost 2 points from front to second month. The front month expires in, at the time of this call, there's another sort of 9 days to go. And so the market is actually reading this very calmly. It's looking at these moves in equities, saying, look, I'm in contango. There's no panic. Once the shape of the VIX moves into backwardation, and you know this as a commodity guy as well, once the market gives you the hint of backwardation, these things can go a lot more crazy. But for the time being, it's coping with it, although we're not far, and I think we need to be mindful about that. So vol is high overall. The market's in very steep contango. What does that mean for investors? It means that it's super expensive to play the VIX. If you are buying the futures and nothing happens, you're going to roll down. And think about what 2 points means, right? 2 points per month over, call it a year, is 24 points on something that is worth 24, 25. So you have a full 100% negative carry if you were to do this every month, which is obviously very expensive. But on the other hand, it's also attracting people that are saying, hey, I can get all this amazing carry. And so what? It's not going to explode, or I will stop out, or whatever. So you build this meaningful position which can compound. And this leads to my third point, which is vol. So the volatility of volatility. The kind of moves you're seeing on the VIX are phenomenal. I mean, the sensitivity of the volatility of the VIX, or the moves in the VIX, relative to what are in all effect tiny moves in the S&P. So you will see, 1% move in the S&P, moving the VIX by 3 or 4 points. I mean, this is really phenomenal. And to me, it's a big warning signal. Okay, it's a sign that, look, guys, this could go any minute. Obviously, there's lots of forces against it, and perhaps the next round of checks and other things that could intervene. But I think the VIX, it's an indicator and a tool that I think is one of the best defenders as and when things go completely belly up. But it's also super expensive to play, which means that, the timing is important, the structures are important. And you have for those who are familiar with options, there's a phenomenal contango, not only in the futures, but also in the vol, and the cold skew is phenomenal. Right now, we're looking at volatilities for the top end strikes close to 300%. Okay, for a 50-60 strike. So even with a few days to go, and the market pricing in some non-negligible probability of this kind of blow up, and the market's not stupid. I mean, people are paying for that for a reason, and yeah, I think in the meantime it contributes to these ideas that I mentioned earlier of complacency and fragility. So I think this is a sign or a signal for caution. In order to have this super bull market, I think you need the vol way lower. That would bring in strategies like risk parity, or trend following, or vol target, all of which effectively they're forced to buy more when the market goes higher and when volatility goes down. That's something that we've seen missing. I mean, some of that buying has stayed on the sidelines because volatility has remained somewhat stubbornly high. And it's not because some of the big banks and others haven't tried to to get the vol to those levels and get that last nail in the coffin that could send maybe the S&P to the targets that they have. But it's all in my opinion, incredibly exciting and dangerous. And if you are prudent in your, staying on the sidelines or mindful of some of these dynamics, you look stupid until things really go. And if and when they go, it's so huge that that mommy and daddy will have to do something about it. The big question is, can they continue to do this forever? Is that something that you can assume that they can stay in control? And I think there are potentially the marginal diminishing returns in the central bank policies and what sort of sizes and trillions. And this is something that we're seeing already, with yield curves doing stuff and markets being tested and things being even more polarized. And so as much as I hope that the vaccines are solving all the problems and will grow our way out of this, I think there's a legacy of imbalances that we need to navigate, and it's challenging. And throughout that process, there's going to be a few things that could, change the regime in which we're in. And I think, volatility is super important, because as volatility changes regime, the market, fundamentals don't matter anymore. The 2 + 2 is not 4, is whatever. And it's whatever the positioning of the market is. And so if the market is long equities, then as volatility flies, equities collapse. And if the market is short gold and volatility spikes, the market will rally. It will just force those and expose those speculative positioning. And so I think it's going to be a matter of time that maybe some of these things get checked. And then it's potentially quite bumpy, because correlations, not only volatility explodes, but correlations polarize, and that feeds on itself, creating exponentially higher value at risk, and brings me back to that point of intervention and central banks, and it's all related. It just feels like the sequel is getting, bigger and bigger. It's not a Lehman 2, it's Lehman squared, as I call it, right?
Diego, if I listen to all of the things that you're saying and kind of sum them together, between an end game of inflation being pretty clear, equity market volatility really picking up, sending some warning signals, equity valuations clearly stretched by anything other than a duration comparison to treasuries. You've got a number of things that you're describing that are suggesting, boy, risks in the system. You'd think, logically, boy, gold ought to be testing its resistances with all this going on. But in fact, the opposite is true. Gold is not only not testing its resistances, but we're actually at what Ola Hansen told us last week is a very critical support level, that if it doesn't break, there could be a heck of a lot further downside if we can't hold this current level, which, as we're speaking on Monday morning, is around 1682. Right at the bottom of the range that Ola told us was kind of the number that has to hold. Why do we have gold down here with all these other things going on? Is it entirely about real yields, or is there more to the picture here?
There's a lot of factors. Obviously, the market's speaking loud and clearly, and there's a bunch of them we can walk through. I mean, obviously, the fact that gold and treasuries are moving hand in hand, it's indicative, of course, with higher nominal yields than gold or any other asset without any specific yield looks less attractive. But certainly, I think they're both in the same bucket, right? They're both defenders, and I think in that sense, that correlation could be justified. The other interesting dynamic, we talked earlier about inflation-deflation debate. We could talk about the reflation-stagflation debate. And to what extent we've seen since August, when the Fed announced this change in stance with respect to inflation, saying, look, 2% is no longer a ceiling, we're going to be accommodative, blah, blah, blah. You've seen basically industrial commodities, copper, iron ore, cyclical commodities like oil up, 45, 50%. In that very same period, we've seen gold down almost 20%. So it's a phenomenal divergence between real assets that goes way beyond just inflation discussions, right, or reflation. So I think gold has been clearly decoupled from the commodity spectrum. It's much more on the U.S. Treasury, and the momentum of those flows is brutal. And I think, those things, again, could be overstretched. Gold is technically clearly oversold. But again, we have a situation that goes and links us to the dollar, right? The dollar, I think a lot of the consensus positioning going into this year was a much weaker dollar. People very bullish the euro or others, EM, China. And obviously we're starting to see that positioning. For the time being, the correlation between gold and these currencies is high in the short term on the sell-off. I think those correlations could break. In fact, we play that very actively in our strategy, things that are gold higher, dollar higher, which are extraordinarily cheap. So I think that could be very interesting in a vol breakout. Undoubtedly, I think there's obviously the fact that perhaps the market got a bit carried away into the summer, making all-time highs, something that I thought it was just a matter of time, and it did happen. We all expected a bit of a fight and perhaps a sell-off, but what we're seeing now is perhaps beyond what most of us would have anticipated, and I think it's clearly a long-term opportunity. But I think we can't forget also, you can't discuss gold these days without bringing crypto into the discussion. And, I think here there's obviously very polarized views. There's lots of people who see gold and crypto as two very viable parts of the solution. Some people are much more extreme and they see gold as just, useless old money and Bitcoin as the new miracle. I mean, I've done a lot of work into this. I published a note called Bitcoin Bubble or Anti-Bubble, where I do a lot of analysis on multiple dimensions, purely trying to understand really. And as I open the article, I say, look, I don't want you to think like myself. I want you to think, right? Which is Frida Kahlo's sentence. But, covering a lot of arguments, I find that there are multiple areas of concern and consideration of fallacies in the process. I encourage people to read through it. Happy to talk about some of those fallacies, like the inflation hedge fallacy, the scarcity fallacy, the value fallacy, that ultimately, to me, help me or lead me to conclude that Bitcoin is 80% bubble, 20% anti-bubble. And I think this is just one more factor. I mean, it's very obvious that very phenomenal traders, have embraced Bitcoin. Some of them perhaps ditched gold. I mean, or at least Bitcoin took a bigger part on the short-term bets. Famously, Paul Tudor Jones called it the fastest horse in the race against inflation, but that was at 8,000. that horse has run a long way, and I think whether it's Paul Tudor Jones or Stan Druckenmiller, who are notoriously bubble traders, when they come into these trades, it's not because they're worth something. They just spotted a bubble, and they'll be making a ton of money on the way up and the way down. So really lots of things there. I think back to gold, it's really many factors. In my opinion, gold is a clear anti-bubble in both for the fiat and for the fiat bubble as well as crypto. And personally, I think that these are levels where, whilst it's impossible to just put a floor, and technically, to your point, I think the market's a bit Darwinistic. Okay, there are so many people in their homes trading historical graphs that have nothing to do with today's reality, right? And they become a bit of self-fulfilling prophecies. And arguably, if everybody's trying to buy the break, then buying the break doesn't work anymore. And you have a new predator around, which is strategies that that cannibalize on people who play on this. And so I'm quite skeptical about many of these things. Of course, the market could look like it breaks and then everybody's in and then it just bounces in your face. So a lot of caution. I think gold can be very explosive as and when. The pressure has been enormous. Liquidation has been notable. And personally, we believe strongly, although we play this mostly through options, which allow us effectively the benefit of having the downside, capped at the premium and then have very asymmetric payoffs, whereby if the market was to continue to sell off, you lose on a mark-to-market basis, but then you give yourself sufficient time, hopefully, to get to see these moves. But it's been phenomenally challenging for anybody that is long gold or gold miners or silver for that matter, which has very strong fundamentals as well, even from the reflation story and others. And so I think gold is truly fascinating. Lots of drivers. I think it's become very unloved. And if I put everything in balance, it's something that I believe you should accumulate. And I'm going to make this last point on gold. I think, we've seen a lot of momentum in gold. People who were on the sidelines came in over the summer because, once it broke, it was going to go to 3K. And then the kind of people that are now throwing the towel are probably those guys that came in. So my recommendation is the opposite. I think here you have to embrace the volatility of the market. You have to embrace the stupidity of the market. And moments like this, when gold is very unloved and equities are super, in my view, expensive, this is not the time to ditch gold and buy NASDAQ or Bitcoin. Personally, I think this might be a time to just calmly rebalance. And so I think it's going to continue to move. We'll see which way it goes. I don't have a crystal ball, unfortunately. And again, these things are not either or. There could be many scenarios where equities and gold go up and inflation does whatever. But I think gold is an interesting asset that I think will have a role to play over the medium and long term. But it's just like everything else, it's super volatile and under a lot of pressure.
Diego, let's come back to the U.S. dollar index, which, of course, is a relative measure of the dollar's strength against other currencies. For the first time since late November, on the day that we're speaking, which is Monday, a few days before this episode airs, we finally, at least intraday, we haven't seen the close above 92 yet, but we're trading intraday at about 92.21 as we're speaking right now. Looks like maybe we're headed toward our first daily close today above 92. That was the previous support level for several months before it broke back at the end of November. Is this a significant reversal? Are we headed back to 102, a new cycle high on the dollar, or what do you think is going on here?
Well, I think the dollar's obviously has been driving everything over the last few months. More recently, it's yields, treasury yields and dollar rates that are at the front of the show. But I think the dollar move is interesting because I would argue that it's been you could almost see within the DXY, you could see different components, almost like subsectors, right? So for the first part, it was mainly the dollar exposing some of the moves versus DM, developed currencies, whereas the euro, giving way from 124 to now 118, or dollar yen, which is also sort of breaking higher and gaining some momentum, or dollar Swiss. And now what we're starting to see, in fact, today is the first relevant move in the yuan or Taiwan or others. There's obviously other types of news and things happening, but the EM train is also starting to be exposed a bit. And I think this is, whether it's the carry trade angle on China or other considerations that are linked, I think the dollar move is largely a positioning move where the long-term yields and the interest rate differential is making the dollar more attractive, but more important than anything is the positioning, which was super crowded. So how far can it go? What does it mean to the overall index and correlations? I think correlations will also break. You will see certain things working better than others. Some of the commodity winners, other losers. So I think if you look at the overall the dollar versus everybody else, I don't see any dramatic change in trend like that is completely sustained. I mean, you could have 5-10% swings one way or the other. But this is a very reactive game where, the central banks that are the countries whose currencies are stronger are defending themselves and are suffering from loss of competitiveness. I think a good example is China, right? I think China, since the summer, we saw the Chinese yuan appreciate by close to 12%, pretty much in a straight line with zero vol almost. And part of that was driven by inflows into, positive story. People are Ray Dalio, the 10-year Chinese government bond paying 3%. And it was almost like free money, right? So I have a currency that appreciates, the bonds pay me 3%, blah, blah, blah. And my point has always been, look, be careful, because as China becomes a carry trade and all these money goes in, if volatility explodes, you're going to start to see some of the behavior that we've seen with other commodity currencies like the Aussie, etc. And so I think in that sense, the dollar, again, it's that volatility in rates is transferring to FX very, very obviously. I think those correlations could add to the volatility. We're seeing a bit of a domino effect, and some of them have been leading, others are lagging. But certainly, for now, it's still somewhat orderly. If volatility was to explode, I think you could see some of these moves accelerate, and that sort of takes out a lot of the technical guys that watch this very carefully and sucks them into the new positions, all knowing that if you do the numbers and 2 + 2, it should equal 4 eventually. But in the meantime, 1.9 trillion and another 1.9, and then Europe, and then the other guy. This is all just parallel inflation, and I think you could see again back to gold. Some of these assets and correlations breaking, and that could be interesting. So I think overall the directional move one way on the dollar the index doesn't do justice to what's happening inside. You need to look into the attribution of the different components, carries and other considerations. And if we go into a risk-off move, I think overall the dollar rallies, but it's not necessarily a sustained rally. It will be something that could run, but there will be responses for sure. We've discussed that before with the Fed and yield curve control and volatility. So it's once again, it almost feels like when you trade carry, you make money 95% of the time, but it's that 5% of the time when things go against you that can blow up so badly. So I think on many markets feel a bit like that carry situation where vol could expose some of the positioning. But yeah, the dollar story goes very closely with rates and vol and equities, and it's all part of the same somewhat artificial setup where the currencies will be controlled to a certain extent, not just by the central bank, but also as a response function to other central banks who are trying to achieve the same game. And that's why currency wars and trade wars are so relevant, right, to the whole thing. It's currency wars is really try to transfer your problem to your neighbor by devaluing your currency, and trade wars is the mirror image of currency wars. Is trying to defend yourself from that monetary abuse, someone effectively becoming more competitive through the FX channel. And by you putting tariffs, you're neutralizing that effect. So currency wars, trade wars go hand in hand. I think they're on the rise. The globalization is being reversed into at least, polarization, and with two main poles, with China emerging and the US. And again, this is all supportive once again of, volatility and geopolitics and many other things that are inherently in these markets, and that I think are considerations to worry about. But yeah, the dollar absolutely key. Technical levels very important. But yeah, I think it all goes hand in hand, and watch out for vol and positioning.
Well, Diego, I can't thank you enough for another terrific interview. Before I let you go, tell us a little bit more about your books, Anti-Bubbles and The Energy World is Flat, and also for the benefit of our institutional and accredited audience, please tell us a little bit more about where they can follow you and find out more about the fund you manage for Quadriga Asset Management. Yeah,
I wrote 2 books. The Energy World is Flat, published with my good friend Daniel Lacalle, who's also been with you a few times, and the Anti-Bubbles. Both of them presented very contrarian thesis at the time of writing. The Energy World is Flat. Oil was sort of 120, peak oil theory calling for 200. And, we were calling for the flattening of the energy world with sort of 30 to 50 oil. That was probably science fiction to many people when we first published. Then it became sort of current affairs, and now it's history. Similar things happening with the Anti-Bubbles, and where I published in 2017, talking about, this idea of monetary and fiscal policies without limits. And many of the things that we're seeing today are being reinforced. Obviously, that end game is critical. I think the important thing for investors and for everybody to understand there's a paradigm shift. The rules of the game are changing, and I think the next decade will be very different. And perhaps just 2 takeaways, which are very important and linked to your point on the strategies that we manage, I think I use the analogy of when you build a portfolio. I think it's very important to understand that it's a team, and as a team, and I use a soccer team, football team. I'm Spanish, but you could use any team. But in soccer, you need strikers, which will score goals and make you money through capital and income gains. But you also need goalkeepers and defenders that will basically do the mirror image. They will make a lot of money in crisis. And I think that's incredibly important. As a coach, you have three jobs. You need to define the strategy with which you play. And unfortunately, this leads me to a key message that we talked about in previous interviews, which is the concept of false diversification. The idea that people build a team thinking, I own different asset classes, equity, credit, high yield, EM, commodities, private equity, private debt. And when a crisis comes, they all fall synchronously in a big way. So you were not really diversified. You thought you were diversified. So I think the first key thing that we try to address with our strategies is to bring goalkeepers. And in that sense, my strategy was best in the world in February last year, one of the best in March. It has suffered more recently, but as a team, I think the strategy proves the point. And I think it's very important to embrace the stability of the market and the volatility. Therefore, times like recently, where some of the goalkeepers like volatility or gold are being sold, I think is an opportunity to rebalance. So I think that's important. If anybody wants to discuss in more detail, feel free to reach out through Twitter at Parrilla Diego. Parrilla is Parrill, so tricky spelling, and Diego, Parrilla Diego, or also through LinkedIn. I'll be happy to just send additional information. But I think it's very important to play with goalkeepers in this match. And I think the second key consideration is when you build your team, think about inflation. With inflation as part of the end game, it's not just good enough to have strikers, midfielders, and goalkeepers. Those strikers, midfielders, and goalkeepers should have a long inflation bias. So you should favor equities to credit, you should favor real assets to cash, and you should definitely favor anti-bubbles to fixed income. With that, I really appreciate and thank you for the opportunity. I hope people found it helpful, and I look forward to much cooperation and success. So best of luck, and overall much health to everybody in this super difficult times.
And Patrick Ceresna and I will be back with our post-game segment as MacroVoices continues right after this message from our sponsor. Did you know that there's a regulator-approved diamond commodity? Every diamond standard coin contains the same geological content of diamonds, so the coins have the same value. Because they're fungible, you trade diamond standard coins quickly and easily, like gold, at a market price. Inside each coin, a wireless computer chip stores a blockchain token. While a custodian holds your coin, you can trade the token instantly. The value is real. It's a blockchain-native physical commodity. For the first time, diamonds are liquid and mark-to-market daily, enabling institutions to build positions and to create securities. Futures are coming to CME Globex, and an ETF is pending SEC approval on the New York Stock Exchange. This $1.2 trillion hard asset is uncorrelated to stocks, bonds, and other commodities. Investors own at least 15% of precious metals, but no diamonds, leading to a secular position-building opportunity. Find out more or place an order at diamondstandard.co.
Now, back to your hosts, Erik Townsend and Patrick Ceresna.
Erik, what a great interview with Diego Parrilla. His views on the market in terms of combining options and get the convexity of options in with these macro views is just so in line with the way I like to look at the markets. But anyway, let's move on, because now joining us is Gold Royalty Corp CEO Amir Adnani for the post-game discussion on royalty and streaming business models and where precious metal streaming comes into a portfolio. Amir, thanks for joining us today.
Hey, pleasure to connect with you.
Amir, it's great to get you on the show. I want to ask you, starting from the perspective of what we learn about precious metals investing. If you went to a conference on precious metals investing, they would teach you that there's three ways to invest in precious metals. Number one, you buy the bullion itself. And the advantage there is you have no counterparty other than whoever's storing it for you, and it's your direct inflation hedge or fiat currency debasement hedge. The next way is to buy shares in an operating gold mining company or silver mining company. The people that are operating a business that makes more gold and silver by digging it out of the ground. And the advantage there is it can actually produce income because unlike the bullion that has no yield, they're creating a business profit as they sell the product that they mine. Then the third way, which is much more speculative, is known as a junior mining company, a company that doesn't actually have a gold mine that's producing gold, but rather they're trying to figure out where the next gold mine ought to go. So they're buying up land, drilling, testing, getting things to the point where they've proven out reserves and they can go to a big gold company and say, look, we found the next gold mine. We've proven that the gold is down there. Buy us out in order to build your gold mine. And that's the most speculative way that we're taught to invest. Amir, what's this royalty streaming thing, which I think Franco-Nevada was the pioneer of? What is this? How does it fit in? What does this idea of streaming and royalties mean?
Erik, in the mining business, royalties have been around for as long as there have been prospectors generating prospects, staking some ground, and then selling it to bigger companies to develop it. Typically, prospectors would keep a royalty interest, a typical 1% or 2%, which generally was what it means is it's a contract. All it means is that when the mine starts producing by contract percentage, 1%, for example, or 2% of the revenue generated, so right off of the top line, is paid to the royalty holder. And typically prospectors would retain this as their major payoff. And that's how royalties were created. You mentioned Franco-Nevada. Pierre Lassonde, who founded Franco-Nevada, funny story how he actually acquired one of his most important royalties in Nevada in the Carlin Trend by answering an inquiry in the Reno Gazette Journal. Pays $1 million for this royalty. And since then, this royalty has paid over $1 billion in the Carlin Trend for Franco-Nevada. And so companies like Franco-Nevada or Wheaton Precious Metals, who have become, Franco-Nevada is, I think, a $25 billion company, and Wheaton is a $20 billion company. These companies have kind of institutionalized the royalty business. Gone are the days where it would only just be prospectors that held royalties. Now these royalty companies have aggregated a portfolio of royalties and provide investors the opportunity to get exposure to the commodity in the form of a royalty. Now, why is this attractive? Royalty and streaming companies have very good operating margins. Franco-Nevada, you mentioned, let's go back to them again. Their operating margin is hovering around 90%. And so what's happening here is that if you're a royalty company, you don't have new capital investments. You don't have sustaining capital investments. Mining is a capital-intensive business. It's one of the most capital-intensive businesses. So when your gross is your net, which is basically what a royalty company experiences, you just get a percentage of the top line. You are not taking on operating risk. You have a portfolio of royalties, so you're very diverse. And ultimately, you have that embedded optionality when it comes to the commodity price. You have embedded optionality when it comes to exploration upside. So you get a royalty on an asset today where there might be, let's say, 1 million ounces in place as a resource or reserves. If the company does a good job and those resources and reserves double or triple, it's not costing you as a royalty holder any money or any risk to realize that upside. Yet, as it happens, you get to benefit from that embedded exploration upside as well. Now, let's talk about streams for a second. And streams are quite interesting. They're not that different than a royalty, but where they're different is that the stream is basically a contract to purchase a fixed volume of the metals, a fixed volume of gold at a fixed price, whereas the royalty is simply a percentage of the revenue. And what's interesting, Erik, is the fact that the father of the streaming model is Ian Telfer, who's also coincidentally the founder of Wheaton Precious Metals, one of the biggest precious metal royalty companies in the world. And they really created the model off of creating a stream on silver, which was a byproduct of the time of mines that produced gold and copper, and there was silver byproduct as well. So it was an excellent way, and you see streams typically set up on mines that operate multiple commodities or metals. And you can basically take one of the metals and create a stream around it while the operator continues to sell the other metals that it has, but uses the stream as a way of financing its operation. And the stream owner gets the ability to have that fixed volume of known amount of gold at a fixed price coming to it, which typically is set up below what the prevailing spot price is. And that's how the stream holder can generate the return. Again, without taking on operating risk or having the ongoing cost, expense, and capital related to owning and operating a mine.
So tell me if my interpretation is correct. Mining, gold mining, for example, is a business where the business you're in is digging holes in the ground in order to get gold out of them. And it's a very capital intensive business. We talk about royalty and streaming companies like yours. It's not a mining business. It really is a capital business. And what you're doing is you're supplying capital to the mining industry with an understanding, almost like investment bankers to the precious metals mining industry, where if somebody is trying to build a gold mine and they need money to buy capital equipment, they don't have access to enough capital to build what they need to build in order to get the gold out of the ground. You're giving them money up front saying, look, here's your $3 million you need for this big fancy crushing machine that you need to break the rock down to get the gold out of it. And we're going to not loan you that money as a loan because the interest rates are too low for us to make a lot of money if we did that. Instead, we're going to trade you that money for a royalty or a stream on your revenue. So as you start taking gold out of the ground, we get cut in on a percentage basis. And you're operating a money that is really mining capital out of the capital stream, like banking or providing financing to the precious metals actual mining industry. Is that a fair summary?
It's a fair summary of what the royalty companies have evolved into. As we talked about what is a royalty or stream on its own. But if you put a collection of royalty and streaming assets together and it becomes a royalty and streaming company, those companies today have evolved into being capital providers, as you pointed out. And the reason for that really goes back to cost of capital. Investors like the business model of an aggregation of royalties that really diffuses both the risk associated with mining and exploration, but nonetheless creates the embedded optionality value of the commodity price exposure and exploration success. So coming back to your point, what I see, and you correctly point out, as the role of royalty and streaming companies today is that they really are an alternative to equity investment or debt when it comes to the capital matrix that a mining company can look at when it thinks about how to raise capital. And generally what we've seen over the last year is that the royalty companies trade at a better multiple than the mining companies do. On, let's just say, pure price to NAV, one of the metrics that you can measure a mining company, a royalty company might trade at 2.5 to 3 times net asset value, whereas a producer might trade at a 1.5 or 1 time net asset value, sometimes below net asset value. And so what that implies is that the market's assigning a stronger, better multiple on the royalty company. That means the royalty company's cost of capital is lower and more efficient. Hence, the royalty company can pass that lower cost of capital over to a mining company that needs capital by being its capital provider and continuing to expand and build the royalty exposure. So absolutely, that's really over the last decade, we've seen this transformation of the royalty industry into being an important part of the financing side of the business for mining companies. But look, at the end of the day, it really is about building these exciting, streamlined ways of investing in resources. And that's what I think investors really like about the royalty model. And I'm excited about it as an entrepreneur myself.
Amir, let's move on to the topic of greatest interest to investors, which is understanding how this fits into a portfolio. Because I understand if what I want is a fiat currency debasement, pure absolute safety play, I want the value, I want to have no counterparties, that's a clear decision. I want to buy gold bullion or silver bullion. The downside is it doesn't produce any income. There's no yield or return on it whatsoever. Then investors are trained to kind of think about where both senior and junior mining companies fit in. The senior mining company gives you some leverage to the price of gold, but it's an operating business that has business risk. It could be nationalized by whatever country it's in and so forth. So you have to think about more risks than you have with bullion. And then in the case of a junior mining company, it's a pure speculation. It's basically wildcatting for trying to find the next gold mine. How do we think about when does it make sense to own shares of a royalty or streaming company? And how should we think about allocations in a portfolio now that there's kind of a new choice on the menu, so to speak?
It really comes back down to the fact that we invest in commodities. You and I like, for example, this what's happening here with gold, because we believe in higher gold prices. If ultimately you're looking for the right combination of commodity price exposure, but at the same time, what brings that torque when it comes to commodity investing, which is exploration success, which is operating leverage, all those points, which is the reason why people sometimes say, well, owning a mining stock in a rising commodity price environment, that's the way to go to have outsized performance versus owning the commodity. What I really like about the royalty investment thesis is that it combines all those elements. Again, it's about the combination of the embedded optionality towards the commodity price, operating success, and exploration success, because all those elements end up affecting and impacting top line, revenue line for the operator. And as a royalty holder, you're getting a fixed percentage of that top line. It really is beautiful. And it really is, I think, why we're seeing why this model has become a fan favorite, really, with institutional investors, the rise of the royalty companies in the precious metal sector, and how some of them, you look at Wheaton Precious Metal, Ian Telfer spun this out of Goldcorp, and it ended up having a larger market cap than Goldcorp itself. Now, mind you, Goldcorp went on to merge with Newmont to become the world's biggest gold producer. But nonetheless, what we've seen here is that this is a business model that has proven to be successful, and the embedded optionality is really what I'm excited about. And it doesn't cost the investor anything to realize that. Once you own the royalty, that's it. You don't have capital contributions. You're not making ongoing investments into the project or into the mine as a royalty holder. And royalty companies really benefit from having a low headcount. Frank Holmes from US Global made an interesting point about how royalty companies, in some cases, in the case of Wheaton Precious or Franco-Nevada, have higher cash flow generation capacity per head or per employee than Goldman Sachs, or top investment banks. That is an exciting value proposition, as well, as you've got small G&A footprint, small team, small overall organizational requirements, yet the ability to generate outsized returns based on that.
And certainly Franco-Nevada and Silver Wheaton, later Wheaton Precious Metals, have proven the huge capital appreciation potential of this business model. Amir, let's talk about your own company, Gold Royalty Corporation, which just went public this week. In the interest of full disclosure, listeners, I am a participant in that IPO. And tell us a little bit about why you decided to get into this side of the business and what Gold Royalty Corp is going to do.
Well, for full disclosure, I'm an investor in it as well and invested in the IPO. But what really got me excited, Erik, as an entrepreneur for launching Gold Royalty Corp was, first of all, the opportunity to team up with individuals who have written the book on streaming and royalty. Here we were just during this interview referring to Ian Telfer and Wheaton Precious Metals. Wheaton Precious was founded by Ian Telfer and has gone on to become one of the largest and most important precious metal royalty companies in the world today. It was spun out of Goldcorp. The former CEO of Goldcorp, David Garofalo, teaming up with him. David has joined me as the chairman and CEO of Gold Royalty, where we've got, between David and Ian, individuals that have operated at the highest levels of the gold industry, having done record M&A deals, having seen the biggest transactions or led the biggest transactions. Ian was also the former chairman of the World Gold Council. To have the opportunity to team up with this caliber of individuals where they're putting their own capital also into the IPO and launch a new company with sponsorship from a bigger player. So in this case, as you know, I'm the founder, chairman, and largest CEO of Gold Mining, a company that has a very large portfolio of gold projects throughout the Americas. We were able to basically underwrite and create 17 new royalties from that existing portfolio, combine that with the team of individuals that we mentioned that have never before done this. You know, it's fascinating. Ian Telfer, since founding of Wheaton Precious, has never before joined to start or to build another royalty company. That's an exciting value proposition for myself and other investors who are joining us on this, where we're combining the royalty endowment that gold mining is bringing to the table, bringing on board a team that also includes other fellow directors that I have here and investors in the IPO, like Warren Gilman, who's been investing in the mining sector on behalf of individuals like Li Ka-shing, the wealthiest man in Asia. You look at the chief development officer that we brought in, John Griffith, who ran metals and mining investment banking for Bank of America, left that to come join us at Gold Royalty. You see a small team, but a team that has the most impressive track record when it comes to the gold industry, the royalty industry, and the mining industry, the mining side of gold. Combine all that together, we had a very successful IPO that closed today. And it is really the foundation for a situation where we're going to go out and I think build a new alternative, something new for investors in the gold sector to look at and consider, that's got the right team with the right balance sheet now after this IPO, a very strong foundational portfolio of royalties. And at a time in the gold sector where the gold price is a bit soft, and it really is the right time, I think, to be acquiring new royalties and to build the business out. Longer term, of course, if you're bullish gold and you believe in higher gold prices, now really is a fantastic time to deploy capital. And we're putting our money where our mouth is. We're doing exactly that.
And again, any listeners interested and want to learn more, Amir's company, Gold Royalty Corp, just went public this week under the symbol GROY. Amir, thank you so much for joining us.
Thank you so much for having me, and look forward to connecting again soon.
We're going to have to leave it there for this week's show. This episode is brought to you by Abax Technologies, pioneering the design of smarter markets that better meet the needs of both market participants and society as a whole. And by Diamond Standard, the world's first regulator-approved diamond commodity, a new hard asset whose time has come. Visit diamondstandard.co. Patrick, what can they expect to find in this week's Research Roundup?
Well, this week you're going to find the transcript for today's interview, as there's also a link to an article from Dylan Grice on central banks are going to overcook the economy, and a link to a David Rosenberg article, Stop Worrying About Inflation. There are bigger risks on the horizon. So you'll find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com or tag it with the MVRR hashtag on Twitter, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Erik on Twitter @Erik S. Townsend. That's Erik spelt with a K, and myself @Patrick Ceresna. On behalf of Erik Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Erik Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.